Hello, everybody, and good day. My name is Julio Dalla Costa. I'm the Director of Technical Accounting at Bramasol. Today, we're going to talk about variable consideration within the revenue recognition model of ASC 606 IFRS 15. It's gotten a lot of attention recently because a lot of companies are trying to automate variable consideration. So before we do that, let's talk about what variable consideration actually is. On today's agenda, we're going to talk about three different things within variable consideration. We're going to talk about what actually is variable consideration. We're going to talk about the constraint on variable consideration. And lastly, we want to give you some examples of what variable consideration looks like. So when you review your contracts, you will know what to look for. As a reminder, we are reviewing the 5-step new revenue recognition model, ASC 606 IFRS 15. When we look at the model, there's 5 steps, and today we are in step 3, which is determine the overall transaction price for the contract. Here, variable consideration comes into focus because as part of your transaction price, you have to determine 2 components. First one being, are there any fixed price components within the contract? The second component, and a new concept within ASC 606, is the concept of variable consideration. So what is actually variable consideration? Well, if you look on the screen, it says, transaction price is the amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods and services. So what does that actually mean? That means that consideration is variable when the amount of consideration is subject to change. Why would things like that change? Is due to timing, performance, or other factors. When we talk about variable consideration, we're talking about items such as a discount. Now, when you give a discount, you can have a dynamic discount, which means that the more you order from a customer, the bigger your discount is. So under 606 guidelines, when you sign a revenue contract, at that point in time, you don't know exactly how much you are going to order. So what the guidance forces you to do is actually estimate. And this is where the estimation and the subjectivity of the new model comes into play. So what is the transaction price in all this? So the transaction price is actually the estimate of the total amount of consideration that the entity expects to receive. What does that mean? And what's my takeaway for this variable consideration concept? The concept is new and must be analyzed and concluded upon for all new contracts within the new revenue recognition framework. So when we talk about variable consideration, and we just mentioned that it's an estimate meaning that you have to make an estimation at the beginning of the contract, even before the contract begins. There's also another concept within the variable consideration process, which is a constraint. So if I estimate something, and then I say, well, I do not have enough information to correctly estimate, and this will result in probability of a significant reversal in the amount of revenue I've already recognized, then under the guidance, I'm allowed to constrain that estimate to 0. An example of this is, if I have an estimate of $500 for my discount, because I don't know and there's a probability of reversal, I can constrain that variable consideration to 0 until such time I have enough information to actually estimate it more accurately. So what does variable consideration look like in real life? What does it look like in your contracts? This is very important for all the good people out there who are reviewing revenue contracts on behalf of their companies. Variable consideration can look like a bonus, a penalty, a return, a discount, Any type of money-back guarantees, refunds, market-based fees, volume rebates, price concessions, SLAs or service level agreements, and liquidated damages. So what does all these have in common? These are all estimates that we don't know how much is actually going to be on day one. On day one, the guidance requires you estimate the bonus or the liquidated damage. But liquidated damages or bonuses that are paid out at the end of a project, we don't know. So therefore, we have to estimate. So using our two concepts, if we know with certainty, which is the probability of reversal, that will not happen, then we can estimate these variable considerations. If we don't know, the guidance says we are allowed to constrain it until we have better information, which will prevent the reversal of revenue. With that, that comes to our conclusion of variable consideration. I hope you found this enjoyable and I hope you found it knowledgeable. If you have any questions, feel free to contact me or anybody at Bramasol. What you see on the screen here is our revenue accounting health check. We look at revenue accounting in 4 aspects, and we would love to talk to you about your revenue process. Thank you and have a great day.